Hey, good morning once again, options traders. Happy Wednesday to everyone. Well, a question that I get a lot from traders is how will dividends affect my options? And this comes up a lot, obviously, if a stock is about to pay a dividend, because traders get really nervous and they say, well, I've heard that call options lose money when the dividend's about to be paid, so maybe I should close my position because it's just going to get crushed when this dividend is paid. Well, that's not necessarily true. It might not really even affect it. And if it's just an ordinary dividend, it's probably already been factored in by the market. But let's take a little closer look at how dividends will affect your options, and that can help you to make better decisions. So let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, dividends, what are these all about? Well, the first thing to understand is that these are just cash payments from a company. I think everybody knows that. And when cash is paid from a company, it absolutely has to lower the company's value. No matter what price the market has determined this stock to be, let's say $100 per share, if it pays out $1 in dividends per share, then it's immediately worth 99. That's just a mathematical fact. You've absolutely taken $1 out of that company's value. So the first thing to understand is that dividends lower the stock's price. And when the stock's price is lowered, it will lower call prices and it will raise put prices. So again, that's fairly intuitive. Just realize that if you own a call, we'd like to see stock prices rise. That makes a call option more valuable. Well, this is just the reverse. As the stock price comes down, not through market movement, but because a dividend is paid, that's going to lower call prices. And then the opposite is true for puts. Puts like it when stock prices fall, but now they're falling not from market movement, but because a dividend is paid. So that's kind of the intuition behind it, and that will help you to understand how call and put prices will be affected. So to dive in a little bit more behind the math, here's really what's happening. Now, we've talked about this in previous videos. Remember that the pricing model sees the at-the-money strike as what's called the forward price. So, for instance, let's say we have a stock trading for 100 and the risk-free interest rate is 5%. So the forward price would just be the current $100 stock price times 1 plus this risk-free interest rate, or 5%. So the pricing model sees the 105 strike as the at-the-money. So try it. If you put the $100 call into a pricing model with 5% interest, let's say for a 1-year option, you're going to see that that $100 call is not going to be a 50 delta. Probably going to be much more like 65, and that's because the pricing model sees it as in the money. So this is the key, is that when we have interest rates, the forward price of that stock gets pushed forward. Now what happens if the stock pays a dividend? Well, let's say it's a 1% yield. And what this means is that if it's a $100 stock, the stock pays kind of an average of 1% or $1 over the course of a year. It's spread out kind of equally throughout the year. Now, again, that's unrealistic about how companies pay dividends, but that's the way that the pricing model sees it. So if this stock pays a 1% yield, so what will happen is that we now have to knock it off of the 5% interest rate. So if we have a 5% risk-free rate and a 1% dividend yield, it's the same thing, effectively, as though the risk-free interest rate is 4%. So now you can see that the forward price is actually 104. So now the pricing model sees 104 as the at-the-money. So now we can see what's happening. We can see here for sure when we include dividends that the forward price, or let's call it the effective at-the-money strike, gets lowered. And when that happens, we know that the call price is reduced and the put price is increased. Okay, so for the dividend yield, as I briefly mentioned before, this shows the rate at which dividends are paid. So if we have a $100 stock and the pricing model says what's the dividend yield, which is different from the dividend dollars. Dividend dollars is saying it's paying $1 or 70 cents. A dividend yield is different. If the pricing model says what is the dividend yield, you're entering a percentage. So if we give it 1%, again, 1% of the $100 stock is $1. So it's effectively paying $1 over the course of a year. This is what they actually call continuous dividends. So now you should be able to see it's not going to have much of an effect. If this stock pays 1% or $1 over the course of a year, how much is that over the course of a month? Well, it's 1/12 of that, or 8 cents per month. Now that we have that, we know that delta determines by how much the call will be reduced and the put will be increased. So watch how easy this is. The $100 call will have roughly a 50 delta, so it's going to get reduced by 50% of 8 cents or 4 cents. And the $100 put will also have roughly a 50 delta, technically minus, but the absolute value is a 50 delta, so it's going to be increased by 50% of this 8-cent value, or increased by 4 cents. So we can see that the call and the put will be roughly equally affected. The call is reduced, the put is increased, and it's by the delta scaled to this amount of interest. So now here's where you have to be very careful with your options, is if it's trading at parity or very deep in the money. So let's say that our stock is 100, and let's say that the 30-day $80 call is trading at 20, which is at parity. Parity, remember, is just a fancy word that means equivalence or equivalent to. So what we're saying here is that the $80 call is behaving exactly like stock. You could buy the stock for 100, or you could pay 20 for this $80 call, exercise and pay 80, in which case you've paid a total of 100. Same difference. So if the $80 call is trading for 20, and that's going to be a condition called parity, we can find out by just adding this strike to its price. And if we get the stock price, or at least very, very close, it's a parity call. And we know that that delta is going to be 1. Now, the corresponding 30-day $80 put will, of course, be trading for 0. So its delta will be 0. And now we can see the answers. So remember, if this is a 1% yield, or $1 over the course of a year, and the delta is 1 on the call, we can see that the call is going to take the full hit of that dividend. It's going to fall by 8 cents. And the puts price will be affected by how much? Will be completely unaffected because it has a delta of 0. So now you can see that if you have a parity option deep in the money, very little extrinsic value, yes, it can make a difference, but we have to say how big is that dividend. And once again, if it's an ordinary dividend, one that the market knows about, it's probably already factored in. So in a case like this, it might fall 8 cents, but after bid-ask spreads and changing stock prices, it's probably not worth even being worried about. But the thing to understand is that upcoming dividends can matter. And that's because if you have a parity option, that call is going to take the full brunt of that dividend's force. If you have a put, it'll be a benefit because the put would be increased. If you have a very deep in the money put, its delta will now be 1 or -1, but it's going to pick up the full value of that dividend. So let's go put this to the test. Let's go over to a pricing model and see if this is really the way that options work. Okay, so now we're back into a pricing model, one of my favorites that I found, option-price.com. Really a great pricing model. So I've got the underlying stock at 100, strike price at 100, 30 days to expiration. I'm going to put interest rates at 0. It wouldn't make a bit of difference, but just to make the calculations a little easier to follow, I'm going to make that 0. For right now, dividend is 0, volatility 25%, and if we choose calculate, it tells us that the call and put are worth the same at 286. Now in this model, notice it's asking for a percent. That's a dividend yield, and it tells you that right there. So if I put in 1, that does not mean a $1 dividend is about to be paid in the next 30 days. I've had people ask me that. The dividend yield is telling us that it is this percent times this stock price spread out over the course of a year. So if this is a 30-day option, probably not going to be much. So let's make this 1%. So we know that that is 1% of 100 is $1, spread out over 30 days, or 1/12 of a year, is about 8 cents. And because we know that these deltas are roughly 50, that the call should drop by about 4 cents to about 282, and the puts price should be bumped up by 4 cents to about 290. So let's put it to the test. Let's make this 1 and see if that's true. And there we go, 282 and 290. So see, a lot of this stuff you can figure out in your head once you understand how it works. Now, what if we had a very deep in the money option? Let's go to parity. Let's see if we can make this maybe an $80 call. There we go. So the theoretical price is 20. That's what we looked at in the presentation. Puts price is 0, delta 1 on the call, delta 0 on the put. So now if we make the dividend yield 1%, which would be $1 over the course of a year, or 8 cents per month, now the call should feel the full force. It should fall by 8 cents to about 19.92, and the puts price will be completely unaffected. So let's try it. Let's make this 1. And there it is, 19.92, and the put remains at 0. Now, sometimes people say, well, wait a minute, what if the stock is about to pay a dividend, and I'm using this model? It's going to pay it in the next 30 days. Well, that's actually easy. We can trick the system, and if you want a $1 dividend to be paid over this 30-day period, make the dividend yield 12%, which is 1% per month, or $1 per month. But now we should see that if we make this 12%, that's $12 over the course of a year, or $1 per month on average. And because the delta is 1 here for the call, it should fall by a full dollar. So it should go from its previous price of 20 to 19. So let's make that 12. And there we go, 19 and 0. So now you can see why people will say that you should either exercise your option or simply close it if it's about to pay a dividend. If you exercise this the day before the dividend date, you can capture that dividend. But for the most part, if it's not a very large dividend and it's a short-term option, it's just not going to make a big difference. All right, so let's go back to where we started with the stock and strike at 100, no dividends, and we have a call price of 286. Now let's say that the stock is about to pay a 20-cent dividend, and you're worried what's going to happen to my options price. Well, if it pays 20 cents quarterly, which is how most stocks pay, that's 80 cents over the course of a year. So again, 0.8, if we make that for the yield, that's going to be about 6 or 7 cents per month with a delta of 50, only about 3 cents. So let's make this 0.8 calculate, and this should drop by about 3 cents. And there we go, to 283. So it's not going to really affect your option at all. That would be absolutely nothing to worry about, this upcoming 20-cent dividend. And as I've mentioned before, if it's an ordinary dividend, it's paid every single quarter, as opposed to a special dividend that the market didn't know about, it's already factored in. That's not a reason for saying, I need to go roll it or close it because of this upcoming dividend. So anyway, I hope that gives you some of the insights and the intuition behind the Black-Scholes model and what's happening with dividends. So if you understand how an upcoming dividend is going to affect your option, you can make better decisions, and that can only mean better trades. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.